So you're up $300 a share on 50 shares. That's 15 grand, right? So
50% of your portfolio in one play.
15, 20%, and that's on your trimmed portion.
Welcome back, everybody, to Be the Trader. Today's gonna be a fun day because we have laptops out, and I have my man Ariel Hernandez here, who's gonna be diving deep into how to scan for great swing setups.
The goal is to treat it like a business, make sure you're paying yourself into that strength, and then trail the rest. Hypothetical, right? You've got a $100,000 portfolio. So let's just say you did 10%. So you would be buying 100 shares, right? So you're buying, and that's like a $90 stock. So you're buying about 110 shares. You'd have to take so many losses in a row to like really do damage to your portfolio. But if you're right, that 100 shares is now up $30 a share in 5 days.
Wow, this number really blows my mind. Over 75% of you who watch the show regularly are not subscribed. If you enjoy the show and want to support us, the easiest and also free way is just to hit that subscribe button. This will help us find new and better guests, and I promise you to continue to work at making this show better and bringing you more value. Welcome back, everybody, to Be the Trader. Today's gonna be a fun day because we have laptops out, and I have my man Ariel Hernandez here, who's gonna be diving deep into how to scan for great swing setups. Ariel, welcome back, brother.
Thank you, man. Thank you. Again,
Absolutely.
nice to see you. So yeah, one of the things that I like to do is kind of like a top-down approach, right? It's like, obviously, you know, it's one thing to say the market's looking good, the market's looking bad, but like, how do we make that determination based on the things that we're trading? And one of the things that, you know, is really important to me is like looking at the ETFs, right? And just kind of starting from there as part of my daily routine, or, you know, even starting with the S&P 500, looking at the SPY, looking at the Qs, looking at the spider ETFs, you know, and then maybe even some futures markets. You know, if I'm interested in trading energy, right? How's crude oil looking? If I'm interested in trading Bitcoin, how's Bitcoin looking overnight? And then just from a technical perspective, right? And we talked about this in our interview, is price will go up and then it'll consolidate. That consolidation is a chance for you to look for low risk entries. And when an ETF looks really good, then you can take it one step further and say, what are the highest weighted stocks within that ETF? Or if it's a uranium ETF, you know, what stocks are in that ETF? And then that's how you come across, you know, a CCJ or a UEC. And then you could say to yourself, wow, that's also got a really nice technical pattern. So it's not just the ETF, it's obviously being support and run up. The ETF is by the underlying stocks, right? And the more weight that an underlying stock has towards the ETF will determine how that ETF looks. So when you look at a QTUM and you start to say to yourself like, wow, this is a, for instance, and the reason that I've got this one, I couldn't remember it off the top of my head, but you know, one of the things that I'll do is when I come across an ETF like this, I do put them in like a nice ETF list. And then, you know, anybody who might use Thinkorswim, you'll just, you know, link your watch list directly to your chart. So as like you're just flipping through them every day, you can kind of look at this. And then you say to yourself, oh, okay, well, what are the top holdings within the quantum ETF? Well, one of them, even though it got pretty beaten up yesterday, is a Palantir, right? But even still, right, look at how strong a Palantir has been. Now, for instance, if a Palantir or a Google or a Microsoft, like these names are still in there, Intel's another one that's in there, IBM's another one that's in there, you know, they're going to have a lot of influence, right? You know, and again, even a stock like Rigetti or IONQ, they're also in here. And during this period where, you know, this thing's in a really nice uptrend in November, in December, you're now getting, you know, similar action in a Palantir, you're getting similar action in an IBM, you're getting similar action, you know, in an IONQ. And then while these names, and again, if you looked at, you know, 1218 and 1219, you can go ahead and probably look at, and I don't know if this is the exact day that they got beaten up, but, you know, 1718. Okay, so that doesn't necessarily line up. But while the ETF has effectively done nothing, so has your underlying stock, for instance. But again, the stocks with the higher weight will be the ones that really drive that ETF, right? In particular, if it's cap weighted. So like the S&P 500 versus looking at something like the RSP, which is equal weighted across the board.
We cover a lot of information on trading here on Be the Trader, but none is more important than the broker you choose to execute your trades. There are many reasons I use Cobra Trading every day, including multiple order routes where I can get fast execution, great availability on locates for hard to borrow stocks, and fantastic customer service. But don't just take my word for it. Both Benzinga and Forbes Advisor have awarded Cobra for best in class for short selling and day trading. Isn't it time you choose a great broker that you'll enjoy working with? Sign up now by using the link below, and Cobra will give you 100 days of free commission, 3 months of free software, and 33% off commission for life. I know you'll be as happy as I am when you trade with Cobra. Now let's get back to the show. How does someone know? Is it just easy Google search?
So yeah, I mean, one of the things that I would tell anybody to do is just start, and I've got a little list here, is start with like your spider ETFs, right? So if you're looking at the XLE, for instance, right? This is your energy ETF. And if you just zoom out on your energy ETF, it has been in a effectively long base doing nothing, right? But if you think about it in the context of where it started from, which is the lows of 2020, even 2021, when this thing really started to make a nice uptrend, it has been very sideways now once it, kind of hit that peak in May, June, while your crude oil, has been going nowhere as well. Mm-hmm. So if you were to say to yourself, like, what will drive energy stocks higher, right? In particular, oil companies, it's the price of the thing that they sell going higher. So if I started to see crude oil get back up above its 200-day moving average, mm-hmm. then I start to say to myself, and the XLE starting to push out of this really long consolidation, now all of a sudden I start to say to myself, right, what are these other energy stocks starting to do? What's a CVX look like? What's an ExxonMobil look like? And then, trickle yourself down into names that move a little bit faster, like, CRK. Now, this is going to be a bit more of a natural gas stock. And same thing with this EQT. And you'll notice, these things have been kind of in a nice uptrend and just recently took out all-time highs of, 2021. So it's like, while... and again, this is the peak in end of 2020 or middle 2022, the ends of 2022, and effectively has done nothing. But then again, really nice technical pattern, pushes back up, goes sideways just above the 200-day moving average, breaks out. And again, anybody can draw a very simple bull flag, right? But now you've got a stock that's pressing higher on good earnings and above the 200-day moving average. And when you think about EQT and you say to yourself, this is a natural gas stock, right? Then you say to yourself, well, how's nat gas looking? So you could look at the nat gas futures, and that would be a /NG. And then you just zoom out on natural gas, and wow, this is, I don't know what he's got going on this computer. But
I don't know what that is.
Yeah, but natural gas effectively since October has been in a very steady trend. Yes, had a little pullback. And again, even if you looked at this pullback period, 128, and even a little bit before that, and you looked at this, this kind of an ugly drop. And again, even today's ugly bar, it coincides almost perfectly with what an EQT is doing today. And even these exact same dates, the 27th EQT has a nasty drop, and your natural gas, futures markets had a nasty drop right on that day. Yep. So it's interesting how, what stocks are doing. They will be moving futures markets. They'll be moving your ETFs and stuff like that. So just from a really like an overview approach, you want to get all of your ETFs, whether equal weighted, whether spider ETFs. What's starting to make it really tricky in this environment is there are more and more ETFs being released every single day. Mm-hmm. Oftentimes, they're even releasing ETFs that are like 2x and 3x leveraged stocks, right? Mm-hmm, so it's like you don't just have MSTR, which is, your crypto, accumulating company. Right. You also have MSTX and MSTU, and some of these are 2x and 3x leveraged ETFs. So you got to be able to differentiate between what's your ETF that is an accumulation of stocks, right? What's your ETF that is just a leveraged stock, basically, and I'll push those to the side, right? Usually I don't want to be trading 2x and 3x leveraged MicroStrategy.
Let's say you find your sector, because someone's watching this, like, all right, I find my sector via ETF, and then are you only going to go after the ones that have like a certain criteria within
I
the
want to
ETF, or only like
I want to
just
look at
curious?
the ones that have the best technical pattern,
Okay.
right? I mean, because
Even
okay,
if it's a low weighted one, if it's one of those ones, like what if it's like a batch of 12 stocks, and the one you like because it's a great technical pattern has like a
1%
2%.
weighting.
Yep.
And that's totally fine, right?
Okay.
I mean, and I think that that's totally fine, because at the very least you can say to yourself, if you then kind of go up that tree and say, well, which one's got the 7% and the 10% and the 13% weighting, and you realize like, oh, these are also looking really good, but they move 3% per day. So
Right.
maybe it's a little bit slow. Maybe it's not enough to like get your juices flowing on thinking, this thing's gonna really make an
Right.
outsized move.
It's a bank.
Right.
Yeah.
Yeah, it's a bank. And so you don't maybe want to be looking at that, for instance. But again, you can look at something as simple as like, this cybersecurity software ETF, and you've got yourself a nice move up and then a consolidation. And this is exactly from a technical pattern what, some of these names are going to do, right? You get your move up and you get a really nice consolidation just under the breakout. And then on the day in which the breakout happens, it's on an increase in volume. And it's the same thing. You can then kind of go and look at your CrowdStrike, and it was effectively a very similar chart. You get this big move up, you finally get back up above the 200, and then you get this nice, almost like a flat base kind of a setup.
So let's say someone's like, okay, now I can find what I'm looking for. Now the next play is you want to get off of a technical entry, right? Whether it's a breakout or something like that to catch some momentum. Is there any tips that you would have for those who are afraid of getting faked out and stuff like that? Like, should they wait for a close? Like anything like that?
I think if especially for people that like go to work at 11 o'clock or 10 o'clock in the morning, you just set your limit order for a buy over prior day's high, and then your stop will be for the low of that day. So reality is that in a really healthy market,
You can
stocks
really do that without being there.
Yep, stocks will go and they won't come back in a really healthy market. And this is also where position sizing is a topic that we really didn't touch upon too much. But when you are a swing trader, if you're sizing in 100% of your portfolio on any one breakout, and then your stop is 4% lower, and you have a 30% win rate, you're going to blow up, right? Because there's just going to be stretches of time where you can't sustain, 5, 6, 7, 8, 9 losses in a row, right? You're going to be in a 20, 30% drawdown on your portfolio. But if you're using progressive exposure and you're only buying 10% of your portfolio in a breakout, right? It's time that is what really pays you, not position sizing. So if you're wrong and you have a 4% stop to low of day and you have a 10% portfolio size, if you're wrong, you lose 0.4% of your portfolio, right? It's that one Rocket Lab, it's that one CrowdStrike, it's the one Alibaba that ends up moving from your entry, right? Where I might have had $1.50 of risk on my Alibaba, but now you're up almost $60 a share, right? So it's that one trade. And now again, do I hold the entirety of the position for the full $60? No, it's like I bought at 85, I sold a little piece at 97, I sold a little bit more today, at like 137. And then the rest, you're just trailing on an ascending moving average. Now, yes, when things get extended from the 50, like today, even on an earnings gap up, you still should be diligent about selling some into that strength, not necessarily thinking this is a good buying opportunity because of how extended you are from the 50. And that's just according to my own rules. But when you size into something and you're wrong, you only have 10% of your portfolio there, right? And I'm then letting the market dictate how many strong setups we find.
So you nailed it on it just briefly, and that was win rate.
Yes,
and you said
low.
30%.
30%.
Right? And so would you say, how can someone be ready to really understand what that means? Could you give them a picture what that means? Because I know everyone's always trying to look for like high win rate. Win rate. So,
well, just imagine how unpredictable the market really is. And imagine needing to have a 70, 80% win rate to make money, right? That becomes very stressful, right? Versus I can still make money and be wrong all the time, it seems like. So it feels like if you are too aggressive during bad moments, that you're constantly in a perpetual drawdown,
right?
Because you're taking small paper cut loss, small paper cut loss, small paper cut loss. But then all of a sudden, you get that one really big trade that lasts for 4 or 5 months, and it's made up for 100+ trades. But along that healthy time frame, if you can catch yourself in a winner, and with a stock that moves for several months and is getting back up above key moving averages, and you like the company, you like the story, and the stock is, doing the technical thing where you're like, institutions, I feel like they're buying the story. And you get yourself positioned in there and it works for a few months. Throughout that really healthy period, you're going to have a few more stocks that pull you into the market, a few more technical, because the stock doesn't just allow you to be in there for 5-6 months without there being a few more stocks within that group, that industry group, or that, you know, that
even
sector.
That stock can reset up. And you can
absolutely, and you can rebuy that, right? So if a stock were to go up, you know, for 6 weeks in a row and then go sideways for 3, right? That's if you read Bill O'Neill's How to Make Money in Stocks, a 3 weeks tight pattern, you can buy it coming out of that 3 weeks tight setup. And even, you know, we can look at a very simple chart like this GEV, just as an example. And this is exactly what strong stocks do, right? They go up, right? And then this is 7 weeks tight effectively, where you just draw a simple horizontal line and you say over the base is good, right? And you have effectively a very simple tight base, and there you go. You get a little breakout. And someone like you're looking for this pullback against that breakout level. If we just extend this to the, if we just extend this to the right, where you go, you know, wow, it basically held that pullback against the breakout level and then took off. Now, again, this name got beaten up on DeepSeek. That's unfortunate. But if you are diligent about selling some 3 to 5 days into that strength, because that's the job.
Why 3 to 5 days?
Because I learned from Pradeep and something like that we mentioned, and I didn't reinvent anything. I just kind of take parts from other traders, which really fit for my own. And one of the things that we learn is that when you catch a breakout, stocks tend to move in a momentum burst for at least 3 to 5 days, right? Could they go much longer? Absolutely. But about 3 to 5 days, and then you pay yourself, right? You got to reward yourself for locating that entry and then buying that breakout, it working for you. Now, again, there are moments when you're going to kick yourself. Like you're going to look at a stock like this AppLovin when it was at $89 and it had a perfect setup, right? So you get this big, beautiful move up, right? Again, an earnings gap up, which we talked about, and you buy that earnings move and it just grinds higher for another quarter. And then it, you know, kind of breaks down a little bit, finds support at the rising 200, pushes right back up and effectively makes a new all-time high. And what does it do? It starts to tighten up on the right-hand side of its chart so that when this thing breaks out again at $89, and I remember this day perfectly, look at how tight this thing is in here. And it's giving you an inside day, another inside day. This little wick is right off of the 20-day. So it's like from a technical perspective, it's been a leading chart in a leading group, which is software stocks, and AppLovin, Palantir, right? Even Twilio and all of these names that are software stocks are just grinding higher. Shopify, a Toast, software. So it's like when you're all these Snow has been coming around. It's just like all of these software stocks are all coming around, and this one was one of your leaders. And so what do? You get a clean little wick off the 20, very subtle, and then you get an inside day followed by an inside day. And if you kind of see this and you're like, okay, I'm game over these highs and back over the 10. Well, if you showed up with a limit order that very next day, on an increase in volume, this thing takes off. The next 2 days, it proceeds to rocket higher. If you showed a little bit more patience, it just went 5 green candles in a row from 89 to 125.
And you're risking like a couple dollars, maybe $1.
If you were in at 89, so effectively, let's just call it that you even chased it a little bit. You bought a 90, and your low is 87. So you're effectively risking $3 on a $90 stock, and hypothetical, right? You've got a $100,000 portfolio. So you're only going to buy 10 to 15% of your portfolio is what I would tell anybody. So let's just say you did 10%. So you would be buying, what are you buying here? 100 shares, right? So you're buying, and that's like a $90 stock. So you're buying about 110 shares. So you're risking $300, right, on your $100,000 portfolio. You'd have to take so many losses in a row to like really do damage to your portfolio. But if you're right, that 100 shares is now up $30 a share in 5 days. Right? So now you're up $3,000 on your portfolio. You trim a little piece. And by the way, this stock doesn't get you, it refuses to close below the 10.
Damn.
Here's your 20-day. And actually, I believe that the way I have this one listed is the 50-day. If I just added another simple moving average, and I just made this one the 20, and we'll just make this one yellow just for educational reasons so you guys can see, this thing even refused to close below the 20-day. So again, if you just beat it into your head that once you trimmed, this has been a leader. I want to just use the 10 and the 20. All right, this thing continues to trend beautifully along that 20. And then what does it proceed to do on its next earnings? Gap up again, right? And this stock, if with an 89 average and call it you sold half and you have 50 shares left, the last of your 50 shares today are at $434. So you're up $300 a share on 50 shares. That's 15 grand, right? So
50% of your portfolio in one play.
15, 20%. And that's on your trimmed portion, right?
Oh,
the other $1,500 you put in your pocket way early to reward yourself for catching that play. Had you held the whole thing, you'd be super happy. But you didn't, right? And that's not the goal here. The goal is to treat it like a business. Make sure you're paying yourself into that strength, and then trail the rest so long as it doesn't close.
There's potential where you could be in 5, 6 of these that you're just trailing.
Absolutely. And the market will pull you in. It wasn't just AppLovin giving you a really nice setup at the time. It was something like Palantir, which you could have bought an earnings gap up. So here you go. This thing is, just consolidating effectively for a few weeks. Gaps up on good earnings at 48, $49. You buy a 5-minute opening range break, and this thing just trends for a very long time. Right? And it doesn't really break down. I mean, even here where it, hardly undercuts the 20, if you had already trimmed, at 65 and you're basically right back at 65, you might still be holding a portion of that piece. Like you might still be holding half of those shares. And then it only proceeds to double from there with a little bit more patience. And again, even at Palantir, if you didn't buy this earnings gap up at 50, well, it gave you another opportunity to do it down here at 20. And again, what'd you get? A 3-day momentum burst and then a sideways consolidation. Right? And for me, so long as it holds the high volume close, which is something we spoke about in our interview, right? And your close on this day would have been 21.87. As long as it's kind of holding above that 21.87 level.
It's accepting price.
Yeah, it's accepting that high volume price.
It's a new area.
It's that exactly. And even, even if you just draw a price level right at that close, you can kind of see how well, even on the day in which it kind of came back, and it undercut it, right? It undercut it. So if it undercuts at that point and now you're below your 20, you're like, I don't really want a whole lot more to do with it. But what did it end up doing? Gapped up on earnings, stops you out the very next day, no harm, no foul. And then obviously it just consolidates and continues. And even like, this little pullback going into its own earnings, this is when the market had that whole whole Japanese scare. And so you had, if you looked at 8.5 and you looked around a dozen stocks, right? All stocks were really getting beaten up that day. But the very strongest ones like a Palantir are finding a support on a, guess what? Rising 200-day, right? So if you're prepared for this kind of an entry, not something that I would be totally comfortable taking, I'd like to see the strength, and then I'd like to look for that consolidation. I don't want to guess that there's going to be strength somewhere. I want institutions to show me that they're still interested in it.
Well, look, man, I know so many people are going to be rewatching this, taking notes, and trying to figure out the best way for them to scan for their own swing plays. And they may have more questions. Where can they find out more about you?
Yeah, it'll be on Twitter, Real Simple Ariel, or in Investors Underground. So, and
what's your name on there? Same?
Real Simple Ariel.
Oh, both?
Yeah.
Okay.
Yep. And so we'll wrap it up. Just people go ahead and look for all of your ETFs and start from a top-down approach, right? Look at the market and always try to ask yourself, where's money going? Where's money leaving? And again, very simple explanation is, look at the home builders ETF and then look at what the home builders are doing. Don't try to guess that they've gotten too cheap, because too cheap can get cheaper and too expensive can get more expensive. And so just start with what looks good, what's above key moving averages, and that's because institutions are interested in them. And then start asking yourself, what are the biggest names within that? Which have the best fundamentals? Which have the best technical
And what
patterns?
are the main moving averages, just to recap?
I just use the 10, the 20, the 50 to gauge how extended something is from it, and then the 200 to gauge the overall big picture trend, right? I don't buy stocks below the 200, and I typically don't want to be short stocks above the 200. Very few, rare exceptions that I do.
Like parabolics.
Parabolics, exactly.
Right.
But I don't like to buy big washouts under the 200. I don't think it's necessary when there are so many stocks already trending above the 200. So start with that. I think that's like a really good place for everybody. Start with the ETFs and then work your way down.
Well, thanks, brother. I appreciate
Anytime,
you being
dude.
here, man, sharing that with everyone else. And again, share this with another trader friend of yours, and we'll see you again. Thank you for finishing today's episode. If you're watching on YouTube, please leave a comment below of one of the takeaways that you are going to implement into your own trading. And if you happen to be listening on a podcast platform, go ahead and leave us a review and let us know what you enjoy about today's episode, because that does go a long way in helping us continue to grow. Again, thank you from the bottom of my heart, and I look forward to seeing you on the next episode.